Okay. Good evening, everyone, and it's been my pleasure to be with all of you. And so everybody is a learned one. Everybody understand valuation, all the nitty and gritties. Everyone stands right. So I will not be going into detail regarding the methodologies, but what I will be focusing upon, like there may be certain tricky things or tricky issues that come whenever we are undertaking any valuation assignment. So just try to touch base upon them, and so there may be like different thought process which goes in the mind when we're dealing with these sort of the tricky issues, right? So what are those tricky issues are, and how to counter that, how we can look into, and how we can resolve those things. So those are the areas where I will be highlighting upon. Let me open the presentation if I can. Is the presentation visible to everyone?
Yes, sir.
So we believe that where we all being sitting, we being all sitting in a very challenging time, specifically when we talk from the valuation perspective as a valuation professional. The reason being because if you look into the market dynamics, the entire like startup ecosystem is there, and every day new things coming up. It is not only like the rudimentary practices that we need to just keep on carrying the same way, but we need to understand more. So when I say valuation per se, I don't just believe that it's being a number game. It's more into understanding the psychology, as well as more into understanding the theme or the storyline of the startup whenever we need to look into the valuation perspective side, right? So when you talk about these days, a lot of the companies that being into the deep tech, some may be fintech, some may be going into the blockchain. So these sort of the companies now start coming to us, and we as a valuer, we need to value them. Now the question that arises is, if it being just being a number game, we can always look into value it based on numbers. But it is not only a number game. We need to understand like what is the market segment in which the startup is, what is the total addressable market, because the projection, when you talk about majorly, we look into like looking into the projection side of the company, the storyline of the company, the cash flow creation ability of the company. But again, when you look into this, we can only validate any sort of projections that come across to us based upon the knowledge that we possess with regard to the total addressable market that particular segment is into. Because every line that is coming, the top line, even if I say the revenue line, that is also coming from the overall market share of that particular segment, market size, market share that this company will going to hold in the time to come. So it all depends upon like what is the total addressable market, and out of that addressable market, what is the market that may be easily achievable market, or you can say like what is the obtainable market out of that. Okay. So this until and unless this concept not being clear, we cannot just blindly go and look at like this is the correct valuation or wrong valuation, the projection being right, wrong, whatsoever. Okay. So there being time in the generally it comes to us that we need to value, and when we value, then at times we ask a question to ourselves whether we are valuing it that's right, wrong, whether that will sell in the market or not. That is again being a question point. Okay. So the crux is we need to validate certain things, and what is the validation that being required is we need to look into like the market size. We need to look into like what are the relative peers or the comparable peer companies that may not be listed peer companies. Okay. Suppose I want to start something, I being a founder and I want to start something, that being into a service line like an urban clap company. So urban clap has already traveled a certain distance. Already A, B, C, D, E, F round of funding already happened in that company. Now, if I today coming up and saying that, okay, I also will be like an urban clap, my segment going to be the same, I cannot say that the valuation that this company is getting, I will get the same value today itself. Okay, because they have already developed certain traction, they have traveled certain distance, they already have the consumer background. So all those things being there in place now. So we need to look into like what is the stage at which we are. So the company stage is very important whenever we are doing the valuation. At what stage we are valuing it, whether we are valuing it just for the seed round, we are valuing it for the next pre-series A round or series A round or B round, at what stage we are valuing it. That also help us in making us like understand like what is going to be the roadmap in the time to come. If somebody comes today and says that I will start this thing, I will also become like an Uber or the Ola, the market may be humongous, the market may be so big, but the question is, you cannot easily penetrate into this segment now. The reason being because they being the big players. If you start something, then if suppose it being the copy paste thing, then what will happen? Even if you start like getting some traction, these players will not going to make you live, because the reason being they have become big, they have the muscle power, they can purchase you back. Okay, they say that I don't want competition in the market. Okay, so this being the storyline, I was about 15-20 days back meeting one investor, and I let you know the name, Mr. Rajan Anandan, who being the Google Asia head earlier, and now he been running the search program of the Sequoia. So we are just having a discussion, and he said that Manish, valuation value थोड़ी ना करते हैं, valuation being carried by the investor. आप कहाँ valuation क्या करोगे? वो तो हम decide करते हैं, तो आप उस number को लाते हो. Okay, so अब एक question होगा कि as a registered valuer, what we are doing? Are we really finding the valuation? Okay, based on my valuation report, you can go and get the funds. Nobody will give the fund based on my valuation or anybody valuation report. Okay, the question is, because investor understands more. Okay, they know the segment, they know the market, they know, okay, this is the right time to take an entry, and this should be the stake dilution that should happen, and this is where I can place my money and can multiply my money. So that is again being the question point that comes to mind. So at times it being a tricky thing. Just a minute, somebody is calling again. Hello. Yes. Okay, sorry. At times I would say that as a valuer, when you are doing the business valuation, a person coming to you and founder is saying that you tell me what should the value I should command. You tell me like what should I go and ask to any investor. And now you are providing some solution and saying that this should be the value range based on certain multiple, maybe revenue multiple, or maybe based on certain future projection. Then you may be doing some level of the valuation where you are saying that this should be the right price you should go and ask for. Okay, but when we say that okay, 200 करोड़ की valuation already decided है, सर एक report दे दीजिए आप 200 करोड़ की बना के. Then question is क्या हो रहा है? We are doing the mathematical calculation and we are saying that okay, we will flow the numbers, bring the value, and say that okay, this is the value of the number. Okay, based on certain set of assumptions and all these things. At times, the valuation as a valuation professional, we at times fail, and I personally see that we failed. One scenario I let you know, there being a company called Great Learning, and Great Learning, we used to do valuation for this company a number of times for different purposes, and we valued this company $100 million. And the promoter and the founder being very excited and said, okay, $100 million are too good valuation, that's fine enough. Okay, we can sell across with 100 million valuation, $1 million valuation. But immediately after 30 days time, Baizu has purchased or the acquisition of this company at $600 million. Now, what is the logic for that? If I say my valuation report is right, wrong, I being the valuer, I have said 100 million and somebody is parking $600 million. He's a fool guy who is parking the money. That is not so. So at times, who is placing the money? That is most important, because maybe the management of Great Learning may not able to see the trajectory, may not able to look at beyond the certain limit, but maybe at the level of the Baizu, though I not being a very fan following of the Baizu, I still believe that being a lot of the bubble that being there, but still just on the matrix I've been talking about, $600 million they parked on the valuation of $600 million, they made the acquisition. But the question is, the type of the muscle power they're having, the type of the market segment they have, the type of the visibility factor they must be having. They must be saying that, okay, we have a lot of connect across the globe, so we can go and sell these particular curriculums across the globe, and there the margin is going to be much higher than this. Okay, so the type. So when I asked this to the CFO of the Great Learning, he said, Manish, I also have no answer to the question what you are raising, because I said that the projection that you given to us, on which we valued it around $100 million, is you provided a different projection to them, or is the same projection you provided to them? He said that dot by dot, the same projection sheet I provided to them. It means that the valuation, that the transaction on the deal, that is not happening at your projected numbers only. It must be happening on something over and above that. It may be some strategic investment round that they are making, and because of that, so much high value they placed to it. And same was the story with the White Hat Junior. You all know the storyline. So this is how at times the numbers fail. I have not done anything wrong. The numbers, based on the number, the value is this much, but numbers not able to give the real story. I don't know whether it's going to be the real story or bad story or what it is. The question is, when we say the valuation of this company has become a unicorn, this is just being a notional number. I personally believe this is nothing like a fundamental number that yes, the company is has traveled very good. The company has very good product or service line or this thing, that thing. But because the investor want it to become the unicorn, so the investor keep on parking the money one after the other. And it may be, you can say, the bigger fool theory. And at the end of the day, who becomes the fool? It is the retailers who become the fool. Now, somebody would say that under the IPO route, it is only a very minuscule percentage which goes to the retailers. Majorly is the financial institutions who are coming up and parking the money in the IPO process. Again, if you look into, it is majorly like where the money is coming from. It is coming through the mutual fund. Mutual funds, they are parking the money as an institutional investor. And whose money it is here? There again, it is the retailers' money in the mutual fund as well. So the crux is like, we cannot at times decide the number game based on what we think upon. It may be at times that you have to sync your mind in accordance with the investor. Don't know whether the company will become a hit, flop, or what is going to be the roadmap going to be. And we have nothing to do with whether the company become hit, bad, or whatsoever. There may be a certain business plan that being provided to us. We validate. If the management is not able to work based on the projection or not able to achieve the numbers based on the projection, then of course 100% the company will not able to bring the value proposition that they have promised for. Okay. Let me look at few of the things. Now there's again sometimes there being a debate that goes like number is number, value is value. So when you say value of the company should be the same in all respect, and it cannot be different. But it is different under different scenarios, I would say. The reason being how, suppose I've been doing the valuation for employee stock option purpose. Suppose an employee stock option is a minority stake valuation. And at the same point of time, suppose some investor is taking a control stake in that particular company as well. So the value that may be for the investor will be very different in comparison to the ESOP employees who are getting the shares. The reason being because that they being the minority stakeholders, but when the control, somebody is coming and taking 30%, 40% stake in the business, he is coming up with a control element. Okay. I place it more better in a way like suppose you take the share of Reliance. Suppose the price of Reliance is 2,500 rupees in the market. Suppose this price is a minority price, a control price, or what price it is. That may be again a question point. So this price that being available in the market, suppose 2,500 rupees, I as a retail investor go and purchase 5 shares of Reliance. So it is what? It is a minority price. I being a minority stakeholder, the price that being available is for the retailers. If somebody says that, okay, I being Bain Capital or I may be a private equity fund house and I want to take 10% stake of Reliance, they cannot go into the stock market and take 10% stake of Reliance. They have to go to the off market, takeover code will apply, and then the Reliance will say that, boss, if you want to take control stake, even 10% is too much in case of Reliance, then you need to pay the control premium over that, if I wish to dilute the stake of Reliance. So in that balance, it is the control premium that being built for every level of the control that you are taking. If you are taking somebody is taking 10% stake, then a lesser control premium need to be paid. Somebody is taking 25% stake, more control premium. If somebody is taking 75% stake, more higher the control premium. The higher the percentage goes, higher the control premium goes. So it is more or depend upon the type of the control that you are taking in a company. Okay. So this being there. Just then again, one example I would love to place before you. Suppose there being 2 companies, and these 2 companies have the same balance sheet, same P&L statement, dot by dot, everything same capital structure, everything remains the same. But one company being run by a person who is 75 years of age, no succession planning, no son, no daughter, and the other company with the same financial numbers being run by 3 professional directors and maybe aged 35, 40 or 50 years of age. And now the question is, will the valuation of the 2 companies going to be the same, different, what it is? Because if I don't tell the background, then based on the financial numbers, the value remains the same, because the numbers, if you apply the multiple, the value remains the same, net asset value, it remains the same. The more important factor is like what is going to be the future roadmap. A person with 75 years of age, there is going to be something that may happen to him, and then who will take care of the company. So it is not only the financial number which talks, it more important is who, what is the storyline is, like what are the, beside the, what are the qualitative factors that may be there beside the quantitative numbers. So this thing also taken care of. So if you go for a meeting to a client and come back and say to your analyst that you take care, these are the financial number, you do the valuation. So the valuation that he'll be doing without the storyline going to be totally different than what is the reality going to be. Okay, so this is again thing. So whenever we look into the valuation, we need to look into the overall perspective. We need to understand like what purpose we are valuing the company. So these are the small things that makes a lot of difference. So these all things, and one thing, this diagram is a beautiful diagram, which is relevant for everyone, right from BCom to this. This diagram never leaves us alone. The reason being, we all take birth, we grow, we mature, we die. So similar is the case of the companies. They start, grow, mature, decline. So take example, like suppose you take example of automobile companies, maybe the cars. So if you look into, every year the new model comes. Why every year the new models come? If suppose the car is performing very well, there's no need of bringing the new model. But because there's so stiff competition in the market, so because of that, there's a need that the changes need to be done, because every particular product has a certain tenure or the life cycle, and every particular product is start declining after a certain stage. And in order to push that thing up, there's a need for bringing the new variants. Similar is the case like when we used to be like small kids. We have like, we know soap means Lifebuoy, washing powder means Nirma, then toothpaste means Colgate, only the white Colgate. But if you look into the Colgate these days, so many variant that may be there. Only 2-3 products I would say that able to maintain themselves for such a longer period, and that may be like the Parle-G biscuit one. Right from the day one when we taken birth till this date, I see that Parle-G being the same. And so there may be certain products, but that may be very exceptional products that may be there. Okay. So these are the different approaches. I will not go into detail. Everybody knows about it. These all methods are of no relevance when we talk in respect of the startup world. I cannot apply the net asset value. I cannot apply the comparable company method, because if you suppose take example, suppose you want to apply a comparable company method in case of the Paytm, the company is into losses. Any multiple of P multiple will give a negative result or a zero result. Any new age companies, you cannot apply the P multiple or EBITDA multiple. Everybody is into the losses these days, right? So the question is, what to do then? So the only thing that being left is that we can, another thing is we should not need to apply the comparable company in a sense until and unless the company is not matured enough. Because if the company is at a very high growth phase and you are saying that I will apply the comparable company method, Raji, and you are saying with multiple of 30, PAT multiple of 30, if I apply on my PAT, company PAT, my company PAT may be minuscule at this point of time, but my top line is growing very fast. So I may be the initial years, I cannot look into applying the PAT multiple. I cannot look into applying the EBITDA multiple. So these things we need to look at what is the stage of the company is. So when there's a high trajectory, when there's so much of the investment round is happening, the only thing which can give answer to the question is the magical discounted free cash flow and no other, right? Another aspect is, should our discounted free cash flow should be the plain vanilla DCF, or it need to be a 2-stage or 3-stage? At times, the answer to this question may be like the company has provided you projections, and in the 5th year also, you are seeing that the company is growing at a growth rate of 40%. So in when the company is growing at 50%, you cannot directly apply 5% terminal growth rate or 4% terminal growth rate. It means that you have not harnessed the growth phase of the company. So what is more important is we should do at least like 2-stage model, H model we need to apply, and make, so it should go like this: from 40%, bring it down to at least 18%, and then bring it down to 4% or 5%. So it will provide a certain leeway for the company, certain breathing space for the company in order to travel the certain distance with a high growth phase. Okay. So this is again thing that needed to be taken care generally for the startup which is going at a very high pace. Okay. And so any question that you have till this time, you can raise certain questions, then we can again move ahead. Any question that is coming to your mind? What is our—
Sir, I have a question.
Yeah, please. Yeah, Sudeep.
Sir, how deep shall we go into the projections, and how much shall we believe in the story of client as to the achievability of the cash flows projected in the financials? So like if the company has recently been incorporated in 2021 and it's a startup and it's a lithium ion manufacturing company, and it is aiming to achieve production levels at around 100 CR, then the next year would be 500 CR. So shall I really believe this story, or just tell the client that is not achieving?
You don't have to believe into any storyline.
Get back to me.
You don't have to believe into any storyline because you are not the investor. First thing first. There might be some investors already interested in making investment at this particular level. Okay. So then he will say that because I already getting the investment round, and you need to look into, because of these projections, that you're able to build that number or not. I recently tell you, like yesterday only, they being a company which been incorporated only 1 month back, and the valuation that they're looking for is $9 million. So you say like $9 million in 1 month, what is rubbish that you're talking about? But the question is, the promoter is a very strong guy, and he is actually infusing the money himself at this valuation. He's saying that, okay,
but then if there is no investor, like if there is no investor and all of the story is in the founders just minds and PPTs, and they are going to get the investment based on the valuation report that I will sign. So what
then you need to be very cautious enough.
In that
then
case.
You need to be very cautious. Yes, of course. If suppose somebody is saying that you give the valuation, I will go and say that, okay, because some independent valuer has valued my company as so much, and I should command this much of the valuation. Then that may be a different story. So it will always be suggestible that if you are providing valuation report for which he will going to meet the investor, then you should always work on certain conservative principles. I would say first thing first. Okay. Then you should also raise a lot of question points, like the numbers that you are saying. Suppose we are sitting today in the month of January, and he has provided to us till 31st March. So from 31st March till this December, what are the numbers that you have stricken actually? Okay. What is that pipeline that you have? Okay.
Estimation.
So what are the estimate costs that you have entered into? Okay. So then you can go deep into and understand, like, okay, these are the principles that you need to satisfy me once I able to provide you the report first thing first. Okay. Another thing forward, like somebody saying like 100 CR, then 500, then so these numbers are should not be the hard punch numbers. These numbers should have the backing before that. Somebody is saying that, okay, I will be going to achieve from 100 to 200 to then 500. Then you should ask a question that for getting to this 200 numbers or 500 number, like from where these numbers are actually flowing into. Okay. Who are the customers are? What is the ticket size of the customer? Suppose if you are valuing some at some edutech company, suppose in that parlance, you will say that what are the number of the students that are enrolling. Okay, what is the price for that enrollment? Like suppose you say like 2,500 rupees is the module price for taking an admission into that. So this price multiplied by number of the student, then you raise a question when you are saying that 500. So whether you are able to bring these number of students to as an enrollment, then he will give an answer to your question. Okay, so we need to be careful enough, because the question is there are so much of the things going on, and once you write the report, it goes to the public later on, and somebody start blaming like they have issued the report, they have hyperbolic valuation, they provided this thing, that thing. So we need to be a little bit more conservative, as well as we should raise certain question which should give certain level of satisfaction to us. Okay, then only we should issue the report. Okay, but most of the time when you say that registered valuer one, then most of the time the value is already being decided. Then you can't do anything for that. Okay, because the investor is already parking the money at that valuation. Then you can only look into the numbers and say that okay, the margins
that
are
I
right
agree.
or not.
That if the investor is already there, he has
Then
value
there's no problem.
certain level. Yeah. In that
And
case,
another point, like somebody comes to you and say that you value it is already being an investor. I already had a discussion with him. Okay, term sheet he cannot produce before you. You ask to him, you show to me the expression of interest. Okay, so expression of interest letter you can at least look for, and if there being an expression of interest, it reflects a certain amount of seriousness into the business. Okay, so that being again, that may be a question point. Okay. Now there may be certain operating assets and certain non-operating assets when we are valuing the business. Take example, there may be one factory which being built over 2 acres of land, and 5 acres of land that may be an idle land. Nothing is there in that land. That's maybe idle land, nothing to do with the business of the company, but that is there in the balance sheet of the company. Now, I suppose as an investor, want to invest into the factory. Suppose that may be the ketchup factory, like Kremika Food or something like ketchup factory, and I want to make investment. What I will look at? I will look at the land, 5 acres that being there, or I will look at the factory. So I will look into more the operational parts, like okay, how functional the factory is, what is the production capacity, at which what is the SOP at which the factory is running. All these things we will look and take care of. But again, that 5 acres of land may have the value proposition, but the question is, I as an investor coming and making investment for roughly 3, 4, 5 years down the line, I will take an exit. So I nothing have to do with the land parcel. Okay, because I cannot say to the investor, to the founder or to the promoter, boss, you sell your land. Because when I made investment, your land price was 54,000 rupees per square feet, 5,400 rupees per square feet, and now it has reached to 7,000 per square feet. Now you sell and provide me, or you provide me the appreciation value also when I take an exit. It will never happen like that way. Okay, so there we need to look into what are the operating assets, what are the non-operating assets. So from the point of view of the founder or promoter, that land may be relevant to him, but that land may not be relevant to me as an investor perspective. Okay, so this thing again can be taken care of, and generally this land parcel will come into picture when we look into the income tax valuation. Okay, that is what is the circle rate of the land and the capital gain computation. Then this thing will come into picture. Otherwise, we just have to look into, okay, what is the cash flow that the company, that the factory is able to create? What may be the comparable thing that we are able to judge the factory? So that may be more relevant, makes sense, rather than the net asset value or the land parcel value. Okay. Just trying to provide a glimpse of the thing which may be relevant, because there are so many things everybody knows about. You all know everything. There may be a time like people ask, sir, you have valued my company based on DCF. Sir, मेरी intangible value तो आपने किया ही नहीं. You have not done intangible value. This at times there may be a lot of the promoters जो लाला टाइप वाले प्रमोटर वो बोलेंगे आपने मेरी तो 20 साल से कंपनी चलती है आपने कहा मेरे ब्रांड की क्या वैल्यू किया. So the question is, when we say discounted free cash flow, it captures both the tangible and the intangible value. Okay. The reason being why? Because when you say, like, suppose you go and purchase Nike shoes, the Nike shoes may be 9,000 rupees price. If you go and purchase Adidas, maybe 6,000 rupees price. If you go and purchase Skechers, maybe 3,500 rupees price. So this branding itself being built into the price of the particular product. Okay. And that is why when I say top line sales, my brand positioning is already being built in that. If I go and purchase a Raymond, already the price being built into that. Okay. Suppose if you go to Nehru Place, वहां पे क्या 500 rupees की shirts मिल रही हैं. So the question is, हर चीज की ब्रांड की अपनी वैल्यू है, वो ब्रांड की वैल्यूज में बिल्ट इन होती है. सपोज रीड एंड टेलर में अमिताभ बच्चन आते हैं, तो अमिताभ बच्चन ही चार्जेस the remuneration for it, like, okay, if I have been endorsing your particular product, then I will be taking this much money, and that money actually being the cost factor for the company. So accordingly they need to build or make the price of the particular product up. Okay, so that is again the intangible, the tangible, and everything being the part and parcel of my DCF. But of course, at time, there may be, like, the company may require purchase price allocation. In those parlance, they may say that, sir, please provide me the value of my intangibles, identified intangibles. It may be the workforce, it may be patent, it may be brand, it may be. So then what you do, we need to bifurcate it out. Okay, out of the total value, what is the value that is going into the identified intangibles? Because identified intangibles, you will get the benefit of amortization, and otherwise if not able to identify it, you're not able to get the benefit out of it. So that may be the reason you need to identify certain identified intangibles that exist, and based on that you can say that, okay, and this generally purchase price allocation we do whenever there's an acquisition taking place. So total consideration I've been paying is 100 CR. Out of that total consideration, there may be assets which may be 20 CR, and then there may be certain identified intangibles maybe of 20 CR. So the balance amount that being remaining is the goodwill portion that is going. Okay, so that is why they need to, so they don't want to book the entire thing into the goodwill. They say that, okay, whatsoever that can be the identified intangibles, we will find it out because we'll get the amortization benefit as well. So that may be the reason for purchase price allocation, how we do that. Okay. Always remember that discounted free cash flows always takes into consideration the control value. It does, suppose I hold, suppose 10 shares of Reliance, and cannot go to the committee of the board of directors of Reliance and say, boss, show me what is the projection of Reliance going to be in the time to come. Because that being a listed company, price sensitive information, they cannot provide it to you, even if you being the part owner of a company. Because when you hold shares, you become the part owner. Because you being a minority stakeholder, you cannot go and command that. But there may be guys who have taken 10%, 15% stake. He can command that. He can say, and boss, show me the storyline. What is going to be the future? Because we invested so badly in your company. Show me the future forward. So they can always get the added advantage, and that is where the control element comes into picture. Okay. One important aspect more, like whenever we do the valuation of companies which are NBFC company, microfinance company. So microfinance company, there is a particular problem in that, like whatsoever the valuation you do as per DCF will come wrong. The reason being why, because when you say that the microfinance company has taken a loan from the bank, and further they are subletting that loan to the other guys at a higher rate of interest. So it means like what? NBFC company is doing what? They are earning commission as an interest portion, like taking the loan from the bank at 9% and providing it to somebody to at 25%. It means that the differential factor of interest is the actual earning of the company. Now, the question is, like, when they take the loan from the bank, that loan is a pure play loan, we should treat it, or we should treat it as a working capital. If we treat it as a full-fledged loan, though of course it is a loan, but if we treat it as a loan, then what will happen? My discounted free cash flow will never able to just give a justification to the answer. But when I say that, okay, because that is a part of the working capital, because that is their businesses. They take the money, they give the money. They take the money, they give the money. Then what is happening? Then of course, this is a working capital portion, and then my valuation will be coming right. Otherwise, my valuation will be not coming right. Okay. So this is needed to be taken a little bit care whenever we do valuation for the microfinance companies. Okay. Then again, very technical questions come. In the hand of the value of one tool being provided, you calculate the cost of equity as per CAPM. There's no other tool left now. So we apply CAPM, we say risk-free beta RM minus RF, and we reach to the number of 15%, suppose. Now this 15% I cannot apply blindly to any company. This 15% I can apply for a company which may be a settled company, matured company, then it may be perfectly fine to apply. But if suppose somebody is coming and saying that, boss, I being a startup, I just secured 1 crore rupees as an initial fund from some angel investor, and if you want to park the money, then you please park the money. Then what is the expectation of you from the startup? Why should I go and make investment into the startup class? The only question is, it may be the return expectation, the higher return expectation, and that's why we are going to take the risk. So risk and return should go hand in hand. So when I say like making investment into a startup, the return expectation is based on the risk profile of the company. Higher the risk profile that may be there, higher the return expectation going to be. Somebody is coming and saying that, boss, I am thinking to start a startup. You invest 1 crore. If you invest, then I will start. You are mad or what? You are not serious, and you are saying that, so you will not invest. Somebody is saying that I already developed a prototype, minimum viability product already being there, and you please look at, and if you feel interested, you can make investment. Then you say, oh, of course, I can look into, and maybe like 25 to 30% is the return expectation that I have. Okay. So this 15% as per CAPM model will not able to work. Then we need to build an additional risk premium based on the expectation and the risk profile of the company. And that is called a small company risk premium, or you can say company specific risk premium. And you can bring it to the level of maybe 30%, 25%, 28%, depending upon the profile of the company, risk profile of the company. Okay. One question that generally comes is terminal growth rate क्या लेना चाहिए? 4%, 5%, 6%. Is any logic to that? What should be the correct one to take? 4, 5, whatsoever it is. Everybody give the answer. वो सब घुमा फिरा के आंसर देने वाली बात है. कोई कहता है इन्फ्लेशन को देखना चाहिए, कोई कहता है जीडीपी को देखना चाहिए, इकोनॉमी की, कोई कहता है कुछ देखना चाहिए. कोई हाई ग्रोथ कंपनी होगी वो कहेगी कि सर टर्मिनल ग्रोथ रेट आपने 5% क्यों लगाया, आपको यू शुड अप्लाई एटलीस्ट 7%. एंड देयर यूज्ड टू बी अ कंपनी, अभी मैं इंटरनली आपको यहाँ पे बोल रहा हूँ, कोई बाहर आपको नहीं जाके बोलना है. There being a company called VLCC, and we being doing the valuation of that company around like 7-8 years back. This was a talk that was majorly around 2013, I believe. Then at that point of time, the CFO of the company said, boss, you are doing the wrong calculation. You are taking just 4% as a terminal growth rate. Our company has yet to spread across the tier 2 and tier 3 cities. So much of the growth potential is there. So you should take at least 7 to 8% as a terminal growth rate. Okay. Now, what is the reason and the logic that I cannot take 7 to 8%? Because when you say terminal growth, we have to calculate till the end. We say that the company will continue forever till the end, till perpetuity. We are applying maybe for certain initial year, maybe a high growth phase may be there. But at the end of the day, suppose I've been doing something which is very exceptional in nature, and I am getting the gross, suppose I am getting the net margin of suppose 60%. And that may be a reality as well, that I'm getting 60% as a net profit. Because there's no competition, no peer, I being a startup, I started this, and because I able to draw so much of the money. If that being so, what is going to be the future roadmap? The only thing that going to be, everybody will start looking at and saying that, okay, this is a segment we also need to start our business. So profitable business. Slowly and gradually, what will start happening? Competition will start prevailing in. And once the competition start prevailing in, what will happen? The margin will start dipping. You need to compete. And automatically, the margin will again come to 20-25%. As well as when the competition comes, then what is, why the cost increases so much? The reason being that you need to do a lot of marketing activity in order to suppress the competition. So because of that, your margin also start depleting. So that may again be the question point that needed to be taken care of. एक क्वेश्चन और आता है, प्री मनी और पोस्ट मनी. प्री मनी वैल्यूएशन करनी चाहिए और पोस्ट मनी वैल्यूएशन करनी चाहिए. Whenever we are doing the valuation, we should always do pre-money valuation. Pre-money valuation plus money infused equals to the post-money valuation. So post-money valuation may be relevant. Somebody says that, okay, suppose if I give you, suppose 5 crore rupees as an investor, then what is the roadmap that you have? What is the post-money impact that is going to create? Then you can say that, okay, the post-money valuation is this much. But again, because I being parking the money to you, I will park at a pre-money valuation. I cannot give a value to you based on my money only. Okay. So whatsoever the valuation we need to do should always be a pre-money valuation. So pre-money valuation plus money infused equals to the post-money valuation. Okay. Terminal growth rate, I already explained to you. Project validation, we need to do it as sanity check. And now here there's one question. Like I take an example of Urban Clap, and the new startup is also doing the similar sort of thing. Urban Clap is still not listed. So what is happening? How to validate my projection then? There is no listed peer company available. How to validate that? We can validate it in a way. We can go and download all the detail and the data of Urban Clap from the Ministry of Corporate Affairs. We can look into जब पहला PAS-3 form file हुआ था, जब investment पहला round हुआ था, at that point of time, what was the revenue line? When the second round of investment taken place, what was the revenue line? So we can always understand like how the entire movement is taking place. And my company suppose going to travel the similar roadmap, then I should know like what are the stages that the company has traveled, what is the revenue line it has strike, at what particular revenue line, what is the investment round that has happened. Okay, so these are all things we need to look at in order to give a validation to that. Otherwise, I cannot validate. Somebody is saying a good story. If I go along with this story, I may not be the valuer then. Okay, then I will say that, okay, you do it this way, I do it this way, I find some number that will not going to serve the purpose, as well as it will not be helpful to him as well, because somebody is not showing the real light, like what is the real story going to be. Okay, so this is where we can provide a certain caution point. And here I personally believe that a lot of the people saying these days, sir, registered valuer में fees कहाँ मिलती है, आजकल तो कोई पैसा ही नहीं दे रहा है. There's a lot of the debate that goes on, but I personally believe that there's no need to go for n number of valuation. There may be good clients who you go deep into the valuation, you charge a premium money and you will get it. But the more important is how you convey and portray the picture to the management. That become relevant. Though of course everywhere there's a competition, but again we have to live with it, and we have to create a certain niche. We need to show more knowledge, and based on that, you command a certain piece to that. Okay, because there may be the valuers who are doing at 5,000. There may be valuers who may be doing it maybe at 1 lakh rupees or 1.5 lakh rupees or 2 lakh rupees as well. So it all depends what sort of the way, the presentation that you make, what sort of the credibility that you hold, how much knowledge you are able to ingrain to the founders or the promoter. That may be also very relevant. Okay. Now there being a concept called discount and lack of control and discount and lack of marketability. It seems simple, but it's very difficult at times. Suppose I've been comparing my company, unlisted company, with a listed company, and I've been taking the multiple of the listed companies, EV by EBITDA or P multiple or EV by sales multiple, and just based on the multiples, 4 or 5 companies are able to find which are similar to my company, and doing the average, multiplying it out with my PAT number or EBITDA number or sales number, and saying that this is the value of my company. That may not be the right approach. First thing first. The reason being because the marketability of my private limited company and the marketability of the listed companies are very different. I can purchase today share of Reliance, maybe 2 days I can sell it off. But once I make investment into a startup, any private limited company, I cannot get an exit point. I can only get exit point at 3 stages, either at the point of IPO or in the next round of investment round, or it may be the buyback of shares by the company. So there is no 4th route that may be available. Okay. So because of that marketability issue, there need to be a discount, and there may be like 15% discount or 20% discount that you can build because based on the marketability point. Okay. Now, one thing, it also depends upon where your company is standing. Suppose I take example. Suppose there are so many companies which have already filed the DRHP. And suppose one Mobivic is a company name which has already filed the DRHP. Then the boat company already filed DRHP. There are so many companies. So they are at the verge of the IPO. So the marketability is not going to be very far enough. But there may be a company which is saying that I am not looking for any IPO, at least for 5-7 years. Then it means the marketability factor is very future distance factor. So we need to again look into like what is the marketability positioning of the company is, and based on that we need to apply that discount and lack of marketability. At times we can apply 2%, we can apply 1%, we can apply 5%, 15% or 20%, depending upon how far from the marketability that company is standing. Okay. Discount and lack of control again. Suppose you are doing the employee stock option valuation, that may be a minority stake valuation, and you are applying the discounted free cash flow, that is a control valuation. You apply certain discount on your discounted free cash flow in order to bring it down to the minority stake level. So that may be again needed to be taken care of. Control premium in India, it ranges from 20 to 37%. Industry sector wise, there's a lot of research report that being available. You go to the Google, find it out, control premium in Indian industry wise, and number of the report you're able to browse through. So you will get every sector wise, industry wise, control premium. Now there may be certain things like terminal growth rate already explained to you. Now, at times there may be not only the equity valuation, but maybe like the investors are parking the money in a startup and they are getting CCD, compulsory convertible debenture, or CCPS or OCRPS or OCPS optionally convertible redeemable preference shares. So we need to address to this issue. And suppose somebody is coming and saying that you do the valuation for the issuance of the CCPS as a registered value. So what is the difference going to be from the equity valuation in comparison to the CCPS valuation? Because they are compulsory convertible preference share, one day they will convert into equity. So first thing first, we need to find the equity valuation of the company. That is first thing. Second, because these are CCPS, there are certain additional rights that may be available to the CCPS holder. It may be the voting right, it may be the preference dividend right. So if suppose there may be certain preference dividend, or in the case of the CCD, suppose there may be certain coupon rate or interest rate, then this coupon rate or the preference dividend, these are going to be over and above the equity share valuation. So we do the equity share valuation. If suppose there's a coupon rate of 5%, we need to build that cash flow of the coupon rate also and find like what is the value that is coming, and we should also add back to our equity value in order to come to the CCPS level. But suppose there may be a case that the conversion ratio of the CCPS is 1:1 and the coupon rate is 0.01001%. It means that there's minuscule coupon rate, there's no coupon rate, as well as conversion rate is also 1:1. In that balance, the equity value of my company and the value of the equity value as well as the CCPS value is going to be the one and the same thing. Okay, in that balance. Otherwise, if there's a coupon rate, the CCPS value or the CCD value should always be over and above the equity value of the company. Okay. Then diluted number of shares. This is again.
Sorry, Manishi. Actually, I have a question here. Can I ask now, or should I park it
Please.
later?
No, not to target later. Just ask, please.
Yeah, sure. Thank you, sir. Thank you. So, sir, regarding this CGBS and CCD, I have actually seen certain term sheets where what they have mentioned is that there is no specific conversion ratio prescribed. What they do is they prescribe some ratios. I
Mathematical
mean,
formula.
they actually prescribe some
Mathematical
ranges
formula.
for the ratios. Yeah. So, for example, the last term sheet that I'm referring to, it said there would be conversion ratio of something like 0.57 to 0.91, something like that. And that is actually based upon the kind of subsequent rounds and the valuation that the company would be getting in those rounds.
And correct.
So
You are right,
if
sir.
you value that kind of CCPS, how would you actually
Right.
counter that situation?
I
Thank
got
you.
your point. So at times, like you look into the term sheet and there being a big mathematical calculation as well, that when the company turnover will reach this much, the market cap will reach this much, then my conversion ratio will this much and this thing and that thing. Okay, there are a lot of future dependency events that may be there. And in that, how to take forward, the question is because you need to value today and you are not knowing what is going to be the future roadmap. Okay, then the only way out that being left to you, if suppose there's no coupon rate that being there, then what you can say is that Is I'm audible now?
Yes, sir.
Okay. There was some disconnection that has happened. Just a minute. Sandeep ji has raised a question that what we need to do at that point of time when there's nothing like fixed, what is going to be the conversion ratio and no concrete thing being provided. Then what we can do that we can write in the report that as on the date of the valuation, we for limited purpose taking it as 1:1 because there's no other point you can do that, and you have to do the valuation because you have to give the CCPS valuation report. We have to write the instrument as a CCPS rather than the equity. Then you can say that as on the date of the valuation, we are taking, presuming it is 1:1 because the event is future dependent. And at the time of the future, when the conversion point will come, then we'll take care and then we'll look into what is going to be the roadmap at that point of time. Okay. So that is the only way out. There's no other way out, I can say in black and white, that because you cannot calculate also the future, the formula that they've been presented in the term sheet. Okay.
Yeah, so sir, actually, I have talked to certain people, and some of them use some option pricing methodology. So, I mean, is that a
Option
fair
pricing
practice?
methodology, yes. On that one, I don't believe that that may be the right practice to look at. And option pricing majorly being whenever you're looking at like something like an option, but this is not like an option. They are saying that I will convert and will decide at a future point of time.
Okay.
Like take example that we've been doing it for a company which being a listed companies, and they've been saying that we are issuing the CCPS and the conversion ratio being dependent upon when the market cap of the company will reach to this level. So as a valuer, I cannot say that I will not believe also, like I cannot give an affirmation also that your market cap will reach to this level. How can why should I believe that your market cap will reach to this level? It is all being the market driven forces, whether you reach or not able to reach. How can I fix that feature in my valuation report? So that is the reason when there's an uncertainty with regard to a conversion ratio or the point of conversion, then we can say that for limited purpose, we are taking it as 1:1. Okay.
Okay. Thank you very much, sir. Thank you.
And a lot of the report we have issued on, there's no problem. Okay.
Okay. Thank you.
Then there being the case of diluted, any other question anybody has? Any question, we can always come to the question first. That is always being more useful to everybody. No question? Okay, then there is a concept called diluted number of shares. Generally, what we do, like we take the balance sheet as on date of valuation, and we say that based on the balance sheet, my numbers that being there are this much, but my equity share numbers are this much. But again, what we need to ask from the management is, please provide us the cap table of the company. What is the cap table? So they will providing you the entire cap table, like what sort of class of the instrument that being issued. It may be equity shares this much, CCPS this much, CCD this much, employee stock option this much, and then the diluted number of shares that they will provide it to you. Okay. If and you also need to look at the conversion ratio if that may be there. So you can convert the CCPS into an equity shares and say that, okay, overall diluted numbers is this much. Or even you can ask to the management as well, please provide me the full diluted cap table of your company. And so that may be the right way to look at. Another thing, when you say like I've been taking, suppose employee stock option, which have already been granted in my number of shares, then I also need to take in my numerator. There's a concept numerator versus denominator. So then also in my numerator, I need to take into consideration the exercise price, the price at which the employee stock option will be allotted to the employees. So because that is the money that will come into the company. Okay. So my numerator amount is coming, my denominator number of options also being coming. So I being matching the numerator and the denominator concept. Okay. Then at times, like there may be a business house which may be doing 3-4 activities, different segments. One is a lifestyle, another is a sports, third maybe there's some pharmaceutical, fourth maybe different segments they are into. I cannot work on any consolidated numbers. I cannot work on consolidated projections. I cannot work on, so that may be the wrong way, because when I look into consolidated projections, then the margins of every segment is going to be different. The beta factor is going to be different. So everything is different for different segments, as well as the multiples that will draw is also going to be different for different segments. So the question is, we always need to do the sum of part valuation and then consolidate it out. That is the best way to look at. Otherwise, on consolidated numbers, if you're doing the valuation, then that may be the wrong way to look at, because you cannot even validate the projection, because it is a composition of the 4 different segments. So how to go about that? So that may be a question. So we should always address it in a way like going to the sum of part method. Okay. Then they make like levered and levered beta, everybody knows about it. Like we need to lever, then unlevered, and then again re-lever it. One thing, like when we're doing the comparable company analysis, then what we are doing, we suppose able to find 7-8 companies which being listed peer companies, and we do the average. Suppose I would always suggest that never go with the average. Average is a wrong calculation. Always look into the median number. What is the median value of those companies are? Because median will help in removing the outliers. Suppose my EV by EBITDA multiple is coming, suppose 20, 22, 25, 29, and 120. If I do the average, then what I've been doing, I've been giving an 120 number also a strong feature in my average number. So it is important, like if I do the median, if I find the median value, then automatically 120 will go away. So the outlier will go away. So median is always being a better number in comparison to the average. So most of the books, if you look at, they look at the average, but at times, if you look, go deep and look at one particular company which has an abrupt number is making all the difference. So it should not be go that way. So we need to be careful enough while applying the average. At times when they're being closer enough, then average and the median does not make any difference. But when the numbers being abrupt, then median always being a safe game to play. This has been the chart that talks about what is the control value, what is the minority value. So net asset value, general parlance book value पे जब हम historical value बात करते हैं, that's a minority value. जब हम fair value करते हैं, suppose there being a land, उसकी circle rate पे value कर लेते हैं, then that may be a control value. Any sort of a comparable company multiple is always being a minority value. I already told you. Comparable transaction multiple method, that's again being a control value, because यहाँ पे क्या हो रहा है, private transactions हो रहे हैं. Somebody taking 10% stake in another company, so that is a control value, because somebody is taking a stake at a certain percentage, so that brings the control value. The discounted free cash flow is again being a control value. I already explained it a number of times. At times, like when we are not going only for the regulatory valuation, but suppose somebody comes and says that you value my startup, what should be the price I should fetch, this thing, then what we generally look at, we apply the first Chicago method and look at like high growth scenarios, survival, success, or low growth scenario. And then we look at like what is the number that is flowing. And then we again discount it again with a scorecard value. The scorecard is majorly being the qualitative factors that we take care of, like who is the founder, what is the who is the co-founder, what is the team size, what is the technology involvement that been there, has any seed round has happened or not, or whether the traction of the company already been built, whether the minimum viability product is already ready or not. So n number of questions. These are the limited questions, but there are n number of questions that you can frame, which will be helpful in building like at what stage the business is, and based on that you can able to provide a certain level of score value, and then you can multiply that score value to that the value that you have derived with. So it is, you can say, double discount. You are discounting first based on the scenario analysis, and then you are again discounting based on the scorecard value, because so when the startup is coming to you, they are coming up with certain hyperbolic numbers, and you have to tone it down based on certain assumptions, qualitative factors. So that may be helpful at that point of time. Okay. Any question till this point? Any question that you need to ask? Please raise a question. I believe questions are more important than just telling the story. So it's always like, what are the challenges that you are facing?
Excuse me, sir.
Yes.
I have a question. Sir, I just wanted to know, like, for ESOPs, can the option price per share could be less than the face value?
You are saying that under the employee stock option,
Yeah.
the option price value less than the face value. First of all, let me clarify you a little bit on this. Like why we do the option valuation? First thing first, what is the reason for going with the option valuation? The reason is because I am not getting the equity shares as on date. So I may get the option. I'm today getting the option, and these options will get converted into equity shares after a certain period of time. Maybe after 3 years down the line, my options will get converted into equity shares. Okay. Now there are two ways to look at it. One is like, I may say that I will do the intrinsic valuation. I will not go with the option valuation. So intrinsic valuation will be what we are saying, that today the per share value is 100 rupees, and I've been providing it to my employees at 10 rupees. That means that 90 rupees, that is a discount I've been providing. Okay. So I have to book 90 rupees as a loss in my books of account. That is a compensation cost under the intrinsic value method. Now you are saying that no, because it is an option and I have to find the option value. So based on the vesting schedule, that you are saying that, okay, what is the exercise price? What is the value of the company? I have nothing to do with the face value of the company in my employee stock option. The only thing I have been looking at, the exercise price, kitne pe employees ko wo de raha hai, and what is the spot price of the company. Ki company ki aaj ki value kya hai. So the difference between two, I've been finding it out with certain other factors like the time value of money, time factor, the dividend factor. And based on this, I've been finding it out, as well as the risk-free rate. I've been finding it out as under the Black-Scholes methodology. What is the option or the call option price value? Like, and this call option price value is always being a differential value in itself. Okay. So I had nothing have to do with the face value of the company. Whatsoever it is coming, suppose I able to find, suppose the option price, call option value is coming, suppose 10 rupees. So 10 rupees multiplied by number of options is the total compensation cost that I've been getting. And this total compensation cost, I have to break it down over the vesting schedule period. Suppose there may be a 4-year vesting period of 25%, 25%, 25%, 25%. So I suppose I have seen that, okay, total compensation cost is coming 1,000. So I need to build 250 per year on my P&L statement as a hit to the company. Okay. Okay.
Thank you, sir.
Okay. Any other question? There are so many questions. The market is so boiling these days with the startup company becoming unicorn. We're doing the valuation, making the unicorn valuations. So right, wrong, how to look into whether these unicorns are really being the strong fundamental companies or not. That may be again be a question point. Is unicorns being a status symbol, or is it just being the notional value? What is it? So there being a lot of the things that been happening. If you look into LinkedIn, so many posts going on regarding the Mamath valuation, such a hyped valuation being. So many things are happening, and as a valuer, we need to be little bit aware about the things that is happening in the market, as well as what the stories are going on. We need to look at, find certain solution and answer to the questions. At times, you're able to find the answer. At times, you say that the valuation that being talked in the market is something out of the mind. We cannot reach to these numbers. Somebody is saying that if the company run for another 100 years, they will not be able to achieve the value they've been talking about. Okay, so a number of things are happening, and with the Paytm debacle, these things have become more prominent. The new age companies, they have the valuation, they have the valuation, but the fundamentally they are lacking somewhere or the other. So that may again be being a very technical point, like whether they're able to suffice in the market or not, whether these new age companies, of course, on the valuation, unicorn, status wise, everything going good, but really they're able to carve the long run picture or not after going, because what happens when you go and bathe in the river Ganga? So it is like IPO is like going into bathing in the river Ganga. So everything gets clear in the IPO process. So if there being some artificial value or notional value being built, automatically it will be cleaned over there. So let's look at like how the things moving, but still what is more important as a valuer, I personally believe that we need to read a lot of things. We need to understand different segments, sector, how they work. Suppose somebody comes and says, sir, हम तो blockchain की ये काम कर रहे हैं, हम तो artificial intelligence, हम तो metaverse पे काम कर रहे हैं. So if I don't understand the market dynamics, sir, हम valuation नहीं कर पाएंगे. तो हमें थोड़ा सा I need to understand those segments कि ये segment कैसे चलते हैं, ये segment की market viability क्या है. So then we able to give more right answer to the questions, or do the more right valuation as well, because then we able to appreciate it more. Otherwise, we'll say that what he's talking about is something out of the world. This thing cannot happen, and this thing and that thing. But the question is, if we able to understand it more, then we able to address the things more. So this is very important. And as a valuer, I would say that there's no need of just going on reading the financial things. We also need to read a lot of the other things beside it. Like somebody is coming and saying like the bikes and the car can be run by the hydrogen pressure. I don't know like what is the mechanism for that, how it works. And so then I'm not able to appreciate it. If we keep on reading more, then we keep on analyzing the thing more, understanding it more, and then we can play a bigger role. And so maybe at times, not only as a valuer, maybe at times as an investor as well, we can look into, okay, these are the good companies where we can invest as well. Okay. So these days, if we look into like everybody is an investor, there's nothing like somebody sitting in a Silicon Valley is an investor. So anybody who may be the CEO, CXO, or anybody who is earning 1 crore of rupees even, he can be an investor. He can invest 25 lakh, 30 lakhs. So there are so many angel network that being available these days. And everybody want to be the part and parcel of with this new asset class of the startup. And everybody want to reap the benefit out of that. So
Excuse me,
recently,
sir.
like, yes.
So I'm so sorry to interrupt. I have a question.
Yeah, please.
How do we factor in or consider non-financial parameters in evaluation?
Non-financial parameter that I already explained it to you. In case of the example, like when they're being a 75 years old guy,
Right,
and
right.
with the same pension, I already explained to you. It all depends upon like how deep you go and understand it. So these qualitative factors at times play a predominant role into the valuation exercise. So whenever we undertake the exercise, we always need to go deep and understand from the promoter the more about the storyline of the business. If you're doing it just for the RV valuation, that may be a different story. But if you're really doing the business valuation of the company, then you need to understand going deep into it. There may be the thing like the business may be run by the father, and the father has run the business very good, but there are two sons, and these two sons, they are not willing to work with each other. So the company in the time to come will finally go to a collapse point if there being these things going on in a family thing. So we need to look into like how the things are. Okay, and the greater the questions we raise, the more the answers we get, and the more qualitative factors we able to build into it. Okay, so when you say like okay, you told me these are the qualitative factor. Now how to build into in your valuation exercise?
Yes.
That may be a question point.
Yeah.
Now suppose I perceive a greater amount of risk, then what I will do as a valuer, of course the projection is one thing that is he explained to me that this is the projection, and I got convinced with it. But still I believe that no, there's something fishy that is being there. Then I can build an additional risk premium, and by building the additional risk premium, my cost of equity, I can bring the value down of the company. Okay, in my growth rate, if I'm taking 5%, I can make it 4%. So there are different ways to play it. Okay, because if the management is very adamant on the projection, they are not willing to change the projection, then you can play with these tools that being available, and it being always being suggested that always be little bit conservative. So if suppose you feel that additional risk premium that may be like 10%, you can make it 12% as well. But you try to bring the number value what actually suits the market, what may be the reality ground need to be. Okay, that may be there.
Thank you.
Okay, I don't know whether I'm able to address to your question or not.
No,
But
you actually did. You actually did. It was very, it was a very valid question. Actually, it is in everybody's mind that how to factor in and consider that that non-financial parameters. Like in your case, the two founders were one is 75 years old, he may die anytime, and then the other two sons who may not as good as the father. Like
the thing that we need to take care of. And again, I would say that valuation is not a number game only, more about a storyline, and the deeper insight that we take, the greater amount of output we able to provide it. Our report will speak on those fronts then, and then they will appreciate, boss, इन्होंने ये सारी चीजों देखी और इन्होंने इस पे factor in किया है. Then this will be more value addition to everyone, and then we ourselves will feel that we have provided something valuable to somebody, rather than just providing and throwing the report at, okay, this is the report,
completing the
just
assignment,
2 hours, just 2 hours time we finished the report and taken 1 lakh rupees, that's all. That is not the only storyline. At the end of the day, when we go for sleep, we should feel certain amount of satisfaction that whatever we done it with the right intention, we done it with certain amount of knowledge, and that is more value addition to everybody, and that will speak from your whatever you say then. Okay. And then few things I can discuss further on more practical side, like suppose, for example, there being a 5-star hotel, and 5-star hotel is on the outskirts. And the footfall of the 5-star hotel is very low. And but if you talk about the premise, the building, that being very costly, that may be in 200 crores rupees, maybe building that maybe. But as an investor, you look at the building, or you look at how the occupancy rate, how the rooms are occupied. You will look into those factors, or you look into like building बहुत अच्छी है, बहुत अच्छा है, इसमें हम invest कर देते हैं. So as an investor perspective, more important is the cash flow. Cash flow is the king. We need to look into like occupancy rate. We need to look into how the beverage section being used, how the restaurant is performing. So if we able to look at those things, then only we can say that, okay, it's the right investment destination or not. Okay. Then again, a few things I would share, like recently I been to Hyderabad, and there there's a body called TIE, TIE TIE. So that's been a global body, but different chapters being there. So I being a charter member to Bangalore, TIE Bangalore, and so there being a global event, TGS TIE Global Summit that been there, and which happened on 12th, 13th, and 14th. And there are about 30 foreign investors. They are majorly from Los Angeles. They came all from there to India, and they are looking at India in a very positive sense, and they are willing to make investment as well. And we got connected with them, and now they say that you provide me good companies, I will make investment. So the question is, if you look into the overall world, India has become the hot destination these days. And in the startup race, India is coming at the second rank. Now look at earlier being at third, and now it being at the verge of the second ranking. So the question is, like, everybody is now looking at India. And the question is now the angel investors as well as these venture capitalists, they are more interested to go deeper. They are not interested in your metropolitan cities. They are interested to go into like tier 2 or tier 3 cities like Jaipur, cities like this Allahabad city, or maybe Varanasi city. And then they find that more value is being hidden over there, because every particular geography or place has its own uniqueness. If अगर जैसे आप suppose you go to Bihar, तो वहां पे क्या है, there being lot of वो मखाना, हम कहते हैं मखाना, बहुत ज्यादा मखाना होता है वहां पे. तो the question is, so आज पहले मखाने को कोई पूछता नहीं था. Now it has become like a diet product कि अगर आपको dieting कर रहे हैं तो आप मखाना ये. तो the question is, now lot of things are coming up, and everybody want to make investment at the initial stage. And I would say one thing, that we all being valuers, that is fine enough. We are getting our bread and butter, but it's always being suggested that if you have money, then out of your entire money, make a certain amount of portion and invest in the startup, because this being the class, asset class, which can always add a lot of value to you. Okay. And so this is again like, because we being into a position where we हम लोग कुछ pitching session भी start कर रहे हैं startups का, and then we'll coming up with our own AIF fund as well. So it will take some time, maybe 1 year down the line for the AIF fund, but pitching session and all we will be starting soon. So the question is, now everybody is burning with desire. Everybody's burning. So we need to think big, a little bit more big, because gone are the days when we sit in India and there was nothing like where to reach and what to do. Now there are so many things that India is doing, and even the government is ready to help. There are so many grants that are being available to the startups. If you go to any of the incubation cell of the AIC, there are 86 AIC Atal incubation cells, and everybody has got the grant from the government, and these grants, they are providing it to the startups. So everything is being available in this ecosystem. If we are not able to use that ecosystem, then we are actually missing the bus. So we need to be more careful. We need to address, if you want to become the mentor for the startup. I being a mentor to this Atal Incubation Cell, BIMTech, as well as to this IIM Lucknow Incubation Cell, ISB Hyderabad Incubation Cell, we see a lot of good companies that are coming and so much of the potential value that being there. So we can always look into like ki kahan pe, if you feel like making investment, you can start with a little bit investment, 1 lakh, 2 lakh, 3 lakh, 5 lakh investment. There's like crowdfunding platforms that is available. So वो केवल ये वैल्यूएशन करके काम नहीं बनेगा, कुछ ना कुछ नया करना पड़ेगा. That is what I would say कि ये bread and butter चलने के लिए ठीक है, but we need to do a little bit more. We need to connect with the right guys. We need to connect with the investors. We need to talk to them, understand them. And आज कई सारे venture capitalists साथ connected हैं, तो आज जो psyche है investors की वो समझ में आती है, what they look at. तो जब उनसे उनकी psyche आप समझोगे तो then valuation roadmap also become very easier then you're able to start appreciating the thing more. Okay, so this being any question that you have, please raise a question, because otherwise I keep on going like this. Any question? No? Let me look at चलिए एक एग्जांपल लेते हैं आपके लिए. Is the slide visible?
Yes.
Slide is visible, sir?
Yes, sir.
So let understand like angel investor कैसे सोचता है, how they look at the thing. So अभी हम financial parameter की बात करेंगे. So they say that, so okay, suppose I will make investment of $1 million. That's pretty fine, but I require a return, and I require at least 25% return expectation I have. And the term that being there is 5 years. So after 5 years, at least I will take an exit. That is there. Revenue as on date, the company is $0.5 million revenue the company has. And 5 year, in the 5th year, the company will be making $1.5 million, suppose. And the P exit multiple, they already decided at the end of the 5th year is 10x. That at least 10x time I will take from the company, whatever X investment I've been making. Now, these are the things which are already there in the mind of the investor. Okay, he's coming up with already certain scenario thing. Now he's saying that if these are the scenario and I will make investment, then what is the percentage I will hold in the company for giving $1 million to the company. So this is the calculation that will help you in getting it done. Required future value of investment. You are saying that $1 million today I'm making investment, and it will be for a period of 5 years. So power 5 and 25% growth rate means 1 plus 25%. That is $3.05 million is the required future value of the investment. Okay. Now at that point, the company is expected to be worth exit value of the company, because exit value you already decided pre-hand. You are saying that 1.5 million is the net income multiplied by 10 times 10x, this is $15 million. So it is saying that the venture capitalist must own 3.05 divided by 15, that is 20.3% stake he will hold for providing $1 million for a period of 5 years at a required rate of return of 25% with 10x P multiple, exit multiple ratio. So this is how they generally take care whenever they make investment, that they have the conceived notion of making investment. Then only they go along that this is how. So आपने देखो कोई भी आदमी 5% और 7% स्टेक नहीं लेता है. कोई भी स्टार्टअप, कोई भी अगर स्ट्रॉन्ग इन्वेस्टर आता है वेंचर कैपिटल, वो कहता है 15%, 18%, 20% स्टेक. दैट इज हाउ इट गोज. So they want to take a certain controlling stake rather than a minority. वो angel investor minority stake ले लेता है initial, ठीक है. Now this scenario how it works. Suppose initial phase में जब startup आया उसको grant मिली. Grant किसने दिया? Grant दिया suppose कि incubation cell ने या government ने या किसी technology department ने. Grant के बाद angel investor ने invest किया. Then what it happens? It goes to the venture capitalist. अब गेम क्या है, जब वेंचर कैपिटलिस्ट इन्वेस्टमेंट करेगा उस पॉइंट ऑफ टाइम पे जो एक चीज देखी जाएगी वो देखी जाएगी कैप टेबल. कैप टेबल में 20 लोग बैठे हैं, 20 एंजल इन्वेस्टर. No venture capitalists want so many people in the cap table of the company. They say, boss, I will make investment subject to the condition that boss आप ये 20 जो है ना, इनमें से 15-16 को आप निकालिए बाहर. I will give an exit at a high multiple and they will mint the money and take the money out. Okay. अब क्वेश्चन ये डिपेंड होता है कि वेंचर कैपिटलिस्ट, बिकॉज ही इज पार्किंग सब्सटैंशियल अमाउंट इनटू द कंपनी, सो दे जो आपका फाउंडर है, फाउंडर यही चाहेगा कि उसका इन्वेस्टमेंट हो, तो जो इनिशियल इन्वेस्टर्स होंगे दे विल टेक एन एग्जिट. एंड आज की डेट में एंजल इन्वेस्टर्स डोंट वांट टू सिट फॉर अ लॉन्गर पीरियड ऑफ टाइम. दे वांट लाइक 1 year, 1.5 year में एग्जिट हमें मिल जाए, हमें 4 times का मल्टीप्लाई इम्पैक्ट आ जाए, दैट्स मोर देन इनफ. वो कोई जरूरत नहीं है मेरे को लॉन्ग टर्म जाने की. ठीक है. सो दैट इज हाउ द स्टोरी बीइंग बिल्ट फॉर द एंटायर स्टार्टअप रोड मैप.
So can you please share this PPT if possible?
I can share post this, no problem. I believe most of the thing I've already covered, and everybody knows as well all the things, premise of value and all this, and there's no point wasting the time of everybody. Okay, that's it. I not going further with any sort of PPT presentation. So any question that you have, please raise question point. Otherwise, we can stop it over here.
Sir, if in case any company has quasi capital introduced, right, and they are like carrying it forward as well, so how do we take basically consider it while doing DCF?
Which capital? I'm not able to get it.
Quasi capital.
Repeat it.
Quasi capital.
Okay. So can you define like what you exactly want to say by quasi capital? Like what exactly you want to say? Like what it is?
It's like the promoters or the founders of the the startups,
Like loans without any interest payments, right, Daisy?
exactly. Yeah. So they have just funded this company so that they want to so that they can carry on the operations of the company or ongoing operations.
I got it.
But once
Let me place my thought on it. Like suppose initially the founder of the company, they say that okay, because the company meet the working capital requirement and in order to run the company, so I provide an unsecured loan. Okay, I'm providing an unsecured loan and without any interest, charging any interest. Okay, and now when suppose you are looking into like calculating the WACC of the company, suppose weighted average cost of capital. In that parlance, the money that being provided is an unsecured loan, whether it need to be taken as a debt or it need to be taken as an equity, what format will need to be taken? That may be a question point, because initially, if you look into like he has provided it at free of cost, but nothing comes free of cost. Okay, that is just for the sake of running the company. They have provided it, but if you need to factor in, then because there is no interest in it, and if we take it as pure play debt, okay, then again maybe a wrong way to look at. So at times, even if they have provided it at free of cost, we can take it as a part of the equity rather than a part of a debt. So that will be giving a more logical answer, because they have infused the money, though there being a liability component that being there, the money has to be returned back to the promoter by the company. Okay, but looking at the capital structure of the company, debt or equity, if we treat it as pure debt and without zero rate of interest, then we're landing it to a wrong plane. Then it will be suggested that if we can treat it more like an equity factor, that he has infused the equity and with a certain expectation like 15% or 20% expectation, then we can look into or counter it to this factor. Okay, but there is no hard and fast answer to the question that you raised, that whether this is right or this is wrong. But we can look into like, okay, without any interest, if there's a debt in the company that is coming, then in my WACC, if I've been calculating with a zero interest, then it is only the cost of equity that been coming. Okay, even if I say you treat it as equity or not, in the calculation itself, it will automatically land it to the equity only. The cost of equity will be there because the WACC, under the WACC, the interest factor is coming zero. Okay.
And is it fine if in one project or assignment I consider it into debt like item sometimes, because I feel that it is more of a component of a debt, right? And in some other assignments, can I treat it as equity? That is all because I have an understanding with the client. Like, can I change my perception client, like, client wise or like a assignment wise? Is it okay? Or do I need to really thoroughly stick to one proposition that I'll be carrying it forever?
Question is this, like, when you are saying that without interest it is coming, and you are calculating the WACC, you are calculating the FCFE, FCFF, free cash flow to firm, and then automatically your WACC and your cost of equity will remain the same. Okay.
Yep.
So it is actually being the cost of equity. So it is more like an equity capital rather than a debt. But when you are saying that enterprise value you already calculated, then from enterprise value coming to the equity value, you can deduct that amount because it is a debt amount.
Because in recent assignment, I have actually deducted it as not debt, but debt-like items, and then I've reduced it from the enterprise values to come to the value for equity shareholders.
That is fine. That is fine.
Right?
Yes, that is fine.
Yep. Sir, I have a question. It's a very, very basic question. I've had this question for quite some time. So since you're handling VCs and you deal with VCs, so I have this query that how are share allotments made at VC level? Like, for example, if a company has, if a company is valued at 100 CR, it has raised an investment of 10 CR, like it has diluted 10% of its valuation. So how do we make allotments to VC? Like, is there a SSE in place, a share subscription agreement in place, or like if they're allotted for shares, like if they're allotted 100% of the shares, like if they put in paid up capital of 10 CR, so they'll be the 100% owners of the.
I got your point.
So I cannot explain this like.
Then I got your point. The question is like, when any VC round comes, it always comes at a high premium. Okay, it never comes at 10 rupees face value.
Agree, yes.
So major of the money that is going to be flown is into the premium security premium account. Okay. And into the share capital, it does only go, suppose 100 rupees is the price, 10 rupees is the face value, 90 rupees as a premium it is going. Okay.
Agree.
Suppose even take example like 5 lakh rupees is the per share value. So only 10 rupees will go to the capital, remaining amount is going to the premium amount, security premium account. Okay. That may be one. And so I believe that this is the answer to the question. Any further?
No, like I have like so many companies which have a share paid up of 1 lakh, and they are raising like 10 crore CR. So कितना ही हम उसको expand कर लेंगे?
Okay, I got it. So I got your point. So now ये जो आप बात कर रहे हैं, this is the case of the issuance of shares. This is not a case of transfer of shares. Okay.
Yes, this issuance and allotment.
जब कोई भी पैसा प्रीमियम पे आता है तो हम उसको इश्यूएंस ऑफ शेयर्स कहलाते हैं. तो हमारे जो 10,000 शेयर्स स्टार्टिंग के होते हैं, जो 1 लाख कैपिटल बिल्ट होते हैं, वो हमारे इनिशियल थे. आज मैं जब ये नया पैसा आएगा, शेयर्स अलॉटमेंट होगा, तो नए शेयर्स इश्यू होंगे. तो उससे क्या होगा कि जो हमारे एग्जिस्टिंग नंबर ऑफ शेयर्स हैं, शो होल्डर्स हैं 10,000 वाले, वो उनका ऑटोमेटिक डाइल्यूशन भी होगा. ठीक है. और ये पैसा प्रीमियम पे जाएगा. उनका जो पैसा आएगा that will go into the premium, that will not go
Right.
into the pure play share capital account. Otherwise share capital में जाएगा तब तो कंपनी को ऑथराइज कैपिटल इतनी बढ़ानी पड़ेगी, वो
बढ़ानी।
स्टैम्प
सो
ड्यूटी।
दिस इज माय क्वेश्चन कि कैसे हम उसको स्ट्रक्चर करेंगे ऑथराइज।
आपको स्ट्रक्चर ऐसे करना पड़ेगा कि अगर आप कहते हो कि 10 करोड़ रुपए डल रहा है कंपनी में और 1 लाख वाली कंपनी में 10 करोड़ रुपए पड़ रहा है, तो 10 करोड़ रुपए जो पड़ रहा है उसमें जो है मान लीजिए 10 रुपए के हिसाब से तो फेस वैल्यू है, बाकी सारा आपका प्रीमियम मनी है। तो प्रीमियम
मैंने
मनी
1 लाख
सिक्योरिटी प्रीमियम,
हाँ,
तो आपको जितना वो शेयर कैपिटल में जा रहा है वो शेयर कैपिटल वाले के रिस्पेक्ट में
paid
आपको
up
ऑथराइज कैपिटल देखनी होगी,
हाँ,
ऑथराइज कैपिटल देखनी होगी। ऑथराइज कैपिटल से पेड अप कैपिटल
आई
तो कम ही
अग्री,
रहेगी।
आई अग्री टू
तो
दिस।
वो आपको वो जज करना पड़ेगा कि कितना जो है हमारे कैपिटल में
दैट आई
जाएगा
अग्री,
चीजें।
लेकिन हाउ डू वी इंश्योर कि जो वीसी 10% पे आया है वो मास्टर डेटा के पर्सपेक्टिव से भी वो 10% ही रहे। तो ऐसा होता है कि अदरवाइज उसके 10% इंश्योर करने के लिए वी हैव शेयर सब्सक्रिप्शन एग्रीमेंट और एसएचए इन प्लेस। सो दिस इज
yes of course
क्वेरी।
there need to be a SHA, there need to be a share subscription
सो
agreement।
उनका
वो तो
परसेंटेज इंश्योर करने के लिए एसएचए होता है।
बिना टर्म शीट के साइन किए तो होगा ही नहीं।
नहीं,
टर्म
लेकिन
शीट तो
हाउ डू
साइन
वी
करनी
इंश्योर कि वो बस 10% पे ही रहे एंड उससे 12% पे नहीं जाए, जबकि एमसीए में अगर हम देखेंगे तो 98 या 90% या इवन 50% उनका ही रहेगा, बिकॉज कितना ही हम शेयर प्रीमियम कर लेंगे अगर 10 CR रहेगा उनकी वैल्यू, तो उनका इन्वेस्टमेंट। तो ये मेरा बहुत ही
नहीं, क्वेश्चन इज दिस,
कंफ्यूजिंग।
ट्राई टू अंडरस्टैंड। नहीं, क्वेश्चन इज दिस, ट्राई टू अंडरस्टैंड। चाहे भले मेरी कंपनी 1 लाख रुपए की कंपनी है, आज मैं सपोज कहता हूं कि मैं केवल 1% स्टेक डाइल्यूट करूंगा अपना, 1% स्टेक डाइल्यूट करूंगा अपना, और उस 1% के बदले में मैं आपसे जो है 10 लाख रुपए लूंगा, ठीक है?
हाँ, तो मैं कंपनी से वैल्यूड एट 1 CR, नहीं
यार की वैल्यू हो गई
10 CR होगी वैल्यू। हाँ,
जो भी, तो वैल्यू हो गई। तो कंपनी कितनी वैल्यू हो गई आप बेस्ड ऑन 1%, तो उसको जो मिल रहा है आपने तो ऑलरेडी डिसाइड किया हुआ है ना कि मैं तो आपको 1% के बदले में दूंगी।
तो ये
तो
1%
उसको तो
मैं
1% ही
पेपर
मिल
में
रहा है।
इंश्योर कैसे करूंगी एमसीए के
पेपर में इंश्योर ऐसे करेंगे कि वो सारा का सारा पैसा प्रीमियम में जाएगा,
तो फिर तो उसकी
शेयर कैपिटल में थोड़ी ना चलेगा।
हाई हो जाएगी, फिर हमें फिर वो वैल्यू निकालनी पड़ेगी।
मैं यहाँ सामने मेरे ब्लैक बोर्ड नहीं है, नहीं तो मैं ब्लैक बोर्ड पे आपको समझा देता, और या इसको ऑफ द क्लास आप मेरे से मैं आपको एक कैलकुलेशन करके भेज दूंगा किस तरह से ये जो है होगा। क्योंकि आपको यहाँ जो प्रॉब्लम हो रहा है वो आपको प्रॉब्लम ये हो रहा है कि ये डाइल्यूशन जो होगा वो डाइल्यूशन कैसे होगा।
हाँ, क्योंकि एमसी में तो 100% उसके पास चला जाएगा,
नहीं चला जाएगा उसको। वो मैं आपको अलग से कैलकुलेशन करके आपको भेज दूंगा, ठीक है? मैं यहाँ पे क्योंकि मेरे पास कोई चीज नहीं है जिसको मैं आपको कैलकुलेट करके बता पाऊँ किस तरह होगा, ठीक है? बट ये श्योर है कि मैं आपको ये चीज बता दूंगा, ठीक है?
ठीक है सर, ओके।
अदर क्वेश्चन? ठीक है, फिर यहाँ पे एंड करते हैं, ठीक है? I can write down.
For you to let me know the complying provision under which I can do valuation of a trust which is gonna convert into hospital very soon.
Please come up again. I have not listened. Please come up again.
I said, if in case if you can help me out with the complying provision under which trust is gonna convert into a hospital very soon. I am really not getting any clue regarding this. I'm like really stuck.
So
it's a valuation case only. I have just come up to you like out of the box. I know.
No problem. But that may be some legal person that may be more helpful. That may not be the valuation guy that may be helpful for this what you're talking about. Okay.
Fine.
Or I can connect you to my legal head. He can give an answer to your question. Mr. Sandeep Jindal is his name. You can talk to him. Okay.
Sure.
I have written my mail ID also on the chat box. If any question that you feel, you can drop down your question. Even you can write the question to me. I can forward it to him and he will give a reply to you. Okay. That can be done. Okay.
Thank you so much.
I believe that's at least something I able to provide it to all of you. I don't know whether I able to give justice or not. Okay, I'm leaving from here. Okay.
Okay.
Take care.
Okay. Okay, thank you, Manish sir.
Thank you, sir.
I am SP Sharma from DGF RVO.
Great, sir. Great, sir.
Thank you,
Great.
sir, for your association with us and taking this session. And your the topic was covered very nicely. And you try to get involved all participants and answered their queries very well. So thank you very much, sir. And thank you, participants, for participating and involving fully in the deliberations. Thank you. Please share your feedback. Thank you very much. Thank you, Madam Kajal.
Thank you, everyone. Thank you.
Thank you.
Thank you, sir.
Thank you, sir.
Thank you. Thank you.